I'm Sophia Tupolev, and this is your TV10 Daily Recap of the top stories in Israel's business community, brought to you by Channel 10, Israel's business and finance channel. The Israel Securities Authority warned that the domestic open banking revolution is being stonewalled by legacy banks. The Israel Competition Authority tightened its M&A oversight with a strict 1800 HHI threshold to curb horizontal and serial consolidation. The Finance Ministry launched a localized 44 million shekel digital wallet stimulus for northern border residents. And in energy, the Ministry of Energy launched a deregulation initiative to combat severe price gouging in the domestic cooking gas (LPG) sector. The government unlocked a 300 million shekel energy efficiency grant program funded by the carbon tax. Solaer Renewable Energy successfully closed a 165 million shekel private placement anchored by Menora Mivtachim and Clal insurance to scale a 1 gigawatt global pipeline. Let's take a closer look at macro. A new ISA report on financial information services finds Israel's open banking reform isn't taking off. The market counts 314,000 registered users and 25 licensed operators, yet three firms control 92% of retail clients and 94% of corporate ones. The ISA points the finger at legacy banks for partial cooperation and slow API integration. Payment initiation, the reform's most disruptive feature, sits at just 0.5% of usage, and loan data queries jumped 28% year over year. The findings confirm what independent fintech operators have flagged for years. Institutional resistance is starving domestic financial innovation. Consumer demand for yield and credit optimization keeps growing, while the banking sector leans on operational friction to protect its net interest margins and fee structures. Until the Bank of Israel and the ISA swap warnings for real sanctions on API delays, foreign fintechs will find Israel retail banking effectively closed. Consumers will stay locked into that high-cost paradigm. And the Israel Competition Authority has released tough new draft guidelines for approving corporate mergers. The updated framework lowers what's called the HHI threshold, a number that tells you how concentrated a market is, meaning whether it's dominated by a few big players or spread across many smaller ones. Now, any horizontal merger producing a post-merger HHI above 1800 or market share over 30%, paired with an HHI increase of 100, will be presumed to harm competition. The authority is also formally expanding its mandate to cover non-horizontal M&A, vertical and conglomerate, serial acquisitions, and the monopolization of user data by multi-sided tech platforms. This tightening pulls Israel into line with the antitrust postures recently adopted by the US FTC and European regulators. Once the 1800 HHI threshold is crossed, the burden of proof shifts to the merging companies. Foreign capital and tech giants running serial acquisition strategies to capture Israeli IP or data moats now face sharply higher transaction friction. The explicit focus on data as an input puts big tech's standard playbook under a localized regulatory microscope and complicates future cross-border tech buyouts. And finally, the Finance and Negev and Galilee ministries launched the North Plus digital wallet yesterday. The program distributes 44 million shekels to roughly 17,000 border-adjacent households, up to 2,500 shekels per family, with funds geofenced via the Clal app for use only within 2 kilometers of the northern border. A separate 30 million shekel allocation provides 24,000 shekels per family to reservists relocating to Kiryat Shmona, Shlomi, and Metula. Let's take a closer look at energy. The Ministry of Energy launched a deregulation push against localized oligopolies in the cooking gas market, that's LPG. Bi-monthly household bills range from 63 shekels to 130 shekels across the 12 largest cities, with Jerusalem spreads hitting 74 to 164, which means over 550 shekels in annual excess costs. The reform here adds a monthly price index and tries to clear the bureaucratic barriers for switching suppliers. Separately, the government also opened a 300 million shekel 3-year grant track for industrial energy efficiency. That's funded by the carbon tax. Factories converting from polluting fuels to electricity, hydrogen, or compressed natural gas can claim 25% to 50% capex subsidies, capped at 3.5 million shekels per project. And finally, Solaer Renewable Energy closed a 165 million shekel private placement at 80 shekels per share. Menora Mivtachim took 6.31% for 115 million shekels. Clal Insurance 2.91% for 50 million shekels. Warrants could add 162 million by April 2028. Following the capital raise, Solaer is slated to enter the TASME 60 index. Tier 1 institutional players like Menora, Mivtachim, and Clal Insurance are not allocating nine-figure capital to Solaer as some speculative green tech play. By injecting 327 million shekels, assuming for full warrant execution by 2028 to accelerate that 1 gigawatt global pipeline, these pension architectures are moving to capture the supply side of a market that the government is actively forcing heavy industry to consume. That's our day. Look for TV10 on YouTube, Spotify, and Substack if you like to read. We'll see you tomorrow.